All right, welcome everybody. Ladies and gentlemen, you're in the right spot. We're going to talk a lot about options today, in particular option spreads, how to do those on autopilot using a secret algorithm that'll help us automatically navigate volatility. We can do this in just minutes a day. So if you're trading credit spreads, option spreads of any kind, maybe familiar with Iron Condor strategy, you'll love this and even more because we have a secret strategy you probably have not used before. So with that said, let's go ahead and get this show on the road. Let's just talk a little bit about speculation. Speculators accept risk, intending to profit on price movement. So they're the Duke brothers there teaching Valentine all about speculation. Of course, you've all seen Trading Places. So with that said, risk disclosure, that's important to get that in front of us and remember that as speculators, we assume risk hoping to profit, but of course there is a risk of loss when you're trading. Past performance is no guarantee of future results, and only risk capital should be used when trading. So let's look at our agenda for today. A little bit about us. We'll look at 3 common barriers to success, stock market indexes versus individual stocks, looking at probabilities from the perspective of a casino and insurance companies. Then we'll dive into high probability options trading, how we can automate that process. We're going to have a demonstration as well as trade alerts, and then we're going to have a special offer for you and then some FAQs. So you want to stick around. There's a lot here. So a little bit about AltaVest. We are an introducing brokerage firm, and we've been doing this since 1997. And of course, we're all very experienced, each having 25 years of experience. We are futures and options specialists. We traded millions of these contracts over the years, and we're hoping to pass along some of what we learned to you. And of course, with that said, we have an awful lot of experience. You can see the growth there in the S&P 500 option space. That's where we spent a lot of time, and that's where we're going to talk about here in just a minute. So we've been a big part of this growth. It's been a great spot to be, and we've learned an awful lot of things along the way, what works and what doesn't work, but we haven't necessarily failed. We think we're more like Thomas Edison. Maybe we found ways that just don't work. We don't like to call those failures necessarily. So with that said, what do clients say about us? They've been a satisfied client of you and AltaVest since 2001, so going back a long time. Also, here's Alex from Italy, been with AltaVest since 1999. He says they really are professionals. So thank you, Alex. I put that Italian flag there for you. And who am I? My name is Eric Gebhardt. I've been doing this about 28 years, co-founder of AltaVest. Began in the business in 1991 and have my BS in business administration from the University of Southern California. I got started in an investments course, and that piqued my interest in options and futures. In fact, that's my textbook. I actually found it a few months ago, and I was paying attention. You can see all my notes there, the scribbles in red and blue. But yeah, it was fascinating at the time. Crude oil had doubled in value, and we were looking at that within the framework of the classroom. So I thought those were instruments that were very intriguing, compelling, very powerful, and I wanted to learn more about those. I did get involved in the securities business with mutual funds, investment companies, insurance as well. I received my license for all that good stuff, but the futures and options space kept whispering in my ear, and I was eventually hired at a options trading firm. That's where I took a real deep dive into options strategies, all the different spreads, the calendars, the ratios, a lot of stuff that we're going to talk about today. So feel free to stay with us to the end. I encourage you to put away all your distractions and let's go ahead and use our time wisely. I promise to not waste your time. Then we're going to have a demo here of a unique approach to trading. And also, we're going to have a special offer for you at the end of the webinar. So stick around, something worth over $18,000. We'll show you how to get on board for free. I'm sure that's piqued your curiosity, and that's actually true. So we'll get started. With that said, 3 common barriers to trading success. You're going to need to jump all these hurdles. This is what we've figured out over the years. There's too much noise in the marketplace. Even a market analyst with a crystal ball. This is a guy we have in our office here, and I guess you could say his track record isn't that great. But you can see here there's always contradictions. This is nothing new. I don't have to explain it to you. Every hour of the day, you're going to see stuff like this. You know, JP Morgan says the one thing that'll keep the stock market soaring, and then Goldman Sachs says the stock market's hurtling toward disaster. So not useful information when it comes to looking at how to position yourself in the markets. Even the best in the world can be wrong. Jim Cramer, far smarter than I am. You know, everyone knows back in 2008, he was asked about Bear Stearns. He said not to be worried. Of course, you know, Bear Stearns ended up going belly up. But the point is, even the best can be wrong. So, you know, how do you really process all that? How do you use that when it comes to actually applying it to trading? Very difficult to do. So with that said, what about looking at performance? You can just look at everything that performed well and just follow along. Maybe you look at all the top ranked, actively managed mutual funds. And what is you just buy all those 5-star rated funds and chase that performance? Let's see what happens. There's something called recency bias. There's a great article in the Wall Street Journal back here in actually about 2 years ago called the Morningstar Mirage. It says here, mutual funds awarded a coveted 5-star rating, only 12% did well enough over the next 5 years to earn a top rating for that period. So here's what that looks like. You can see here all the 5-star funds slumped over a 3, 5, 10-year period of time, became a 3-star fund. And the 1-star actually increased their rankings up to almost 2. So everything converged to this 3 to 2 average range. So as the phrase goes, past performance really is no guarantee of future results. So that's something to keep in mind when you're looking at chasing performance. Not always a good thing to try to do. So why is it so difficult? What makes it so difficult to pick stocks or funds? And well, you have to do so many things correctly all of the time. For example, let's take a look here. You have to pick the correct stock in the correct market. You have to pick the correct direction, the strategy, your timing, your entry timing and price, and then your exit. How do you manage the risk and reward? So that is the trick. There's a lot of variables there to sort of juggle, I guess you could say, and balance, and you have to do all those correctly. Turns out that monkeys might be the best stock pickers. How about this? Here's a test here with 100 monkeys throwing darts at the stock pages. Average monkey outperformed the index by an average of 1.7% per year since 1964. So if you're looking for a hedge fund manager, this little gentleman here is your man or woman. Can't quite tell there, but good looking monkey there. So those are the best stock pickers, as it turns out. I remember those studies from several years ago, way back when, actually in school, and I think it still holds true. They do that, you know, periodically. So that's an article from Forbes. And how about emotions? So if you can't chase performance, you can't rely on pundits, well, maybe we should look to our emotions. Maybe that's part of the problem. We can become our own worst enemy. When you're trading, you feel all these things, don't you? The frustration, the fear, the greed, the anxiety, all those things, the hope. Well, we're wired poorly with a built-in bias leading us to make poor investment decisions like chasing past performance and selling out after market correction for fear of losing more money. So I think we can all relate to that sensation. Now remember, this is a great comment to keep in mind from Ed Sequoia within Market Wizards. Great book. I'd highly recommend it. It can be very expensive convincing the markets that you are right. So markets are always right. We aren't. And part of that is we complicate matters. Here's I thought this was a really cool looking chart, but makes no sense to me at all. And a lot of times people load up on all these bells and whistles, and quite frankly, it doesn't do them any good at all, and probably is more harmful than not. So really, it's time to simplify and break through all those hurdles. And that's what we're going to talk about. So let's jump into stock market indexes versus individual stocks. An index, as you know, represents an entire stock market, tracking the market's changes over time. You know all these, the Dow Jones Industrial Average, the NASDAQ Composite, S&P 500. So we're going to talk a lot about the S&P 500 today. It was the 90 until 1957. Of course, now You know some of all the big names there: Berkshire Hathaway, Coca-Cola, Kellogg, Chevron, considered the best representation of the overall market and health of the economy. So here's what the S&P has done in its lifetime. Obviously, a large upward bias there as the growth of the country keeps moving along. But of course, along the way, a lot of volatility. So why an index and not an individual stock? Well, it's convenient for one thing. You can follow just one or two indexes and not thousands of different stocks and funds and ETFs. And then also they're less volatile. A large move in a stock index might be 3% in a day. That'd be a pretty big move. But individual stocks routinely move, as you see, 10, 20, 30, maybe 50% in a day. They can be very volatile. Here's Federal Express versus the S&P 500. You can see here S&P in the blue line just trading away, happily trading, and then the S&P 500 just fell out of bed, just collapsed. I'm sorry, the FedEx market, FedEx collapsed, and the S&P did absolutely, really just kind of yawned. Didn't really care too much about it. So a lot of volatility. Here's TD Ameritrade when Schwab announced their commission-free stock trading, just completely lost, I think over 25%, just from one day to the next. And here's Tesla, familiar with Tesla and the S&P 500, just for comparison. You see the volatility there in the black line compared to the S&P 500. Much less volatility. Here's Facebook, closing one day, 4 days later, 5 days later, it's down 21%. Meanwhile, the NASDAQ composite during that same time was only down 3.8%. So big difference between individual issues and an index. And they can also be non-correlated, move in different directions. Here's Under Armour up 2.4%. At the same time, the S&P was down over 1.6%. So nothing too profound or not much of a revelation, but it is kind of interesting to look at that, and I'm sure you've all experienced that before. So just for quick review, now we're going to look at insurance companies, casinos, and how they use mathematics and probabilities. We all know how they make money in the insurance company. We pay them premiums. They collect our premiums, and they hope they don't have any large payouts. So they are paid to assume and then manage risk, calculated risk. So they're essentially selling and managing time, but they do hedge themselves and insure themselves, and they are consistent and patient with their business plan. And they look at probabilities knowing that in the long run, those probabilities will favor them. So they look at things like basically basic statistics, some maybe not so basic at times, but I'm sure you're all familiar with the actuarial tables and so forth that insurance companies use, and things like expected return. So just pure and simple numbers, data, and math. Now let's look at a casino. Oftentimes they're referred to as the house. Here's a roulette wheel with 38 numbers. Let's say you were to bet $100 on that green zero, and you spun the wheel 38 times. Well, the odds are you would win once and lose 37 times, winning $3,500 on the one spin and then losing $3,700 on all the other losers. So the net result would be a $200 loss, or $5.26 on average as your loss per spin. And that becomes the house edge. So you're losing, your loss becomes the gain for the house. But of course, the house knows that they will pay winnings at times on particular spins, but in the long run, they have that edge. So what about a baseball analogy? High probability and base hits, not trying to hit home runs. Maybe some of you know that if you try to hit a lot of home runs, you're probably going to strike out. Well, you will strike out a lot more often than someone who's trying to just hit base hits. Here's a batting champion, name was Rod Carew. He hit no home runs and he still won the batting championship. In fact, that was kind of like his whole career. Hardly any home runs at all, and he won multiple batting titles, most valuable player awards, so on and so forth. So that means lots of base hits, not striking out a lot. So what about that concept? How do we apply that to options trading, something we like to call the high probability option strategies? I'm sure you've heard that term if you've traded options. And what exactly does that mean? So we'll take a look at that. So how would you collect premiums? Let's call these base hits by selling specific options. You need to be consistent and patient, manage that risk, knowing that you will have losing trades, Manage your reward, of course, not getting too greedy. You need the proper tools. And remember, lots of base hits, not going for the grand slam. So let's look at credit spreads. Starting to get interesting now. Collecting premiums, insured positions, predetermined risk and reward, and they may be non-directional in nature. And that's a key point there. We're going to really dive into that. So your maximum reward is the net premium you collect minus your commissions and fees. And the maximum risk is the difference between the short and long option strikes minus the premium that you receive. But of course, you have to factor in your commissions as well there too. So we're going to look at a chart and it'll make it real clear. So don't worry about that. You don't quite get it yet. Now remember, we're trading option spreads. That means many options combined together into one net price that's traded as what we call an object. So a spread could be two options and have two legs, or four options with four legs, or even six. And we'll show you that. It sounds complicated, but we have made it easy. And you will want to see this. So let's look at the first example of a credit spread. Selling a call spread. So you're selling the spread, you're hoping to collect premium. It's a bearish to neutral strategy. Sell a call and you limit your risk by buying a higher strike call of the same expiration. So here's what it looks like on a graph. So let's say you sell a 28.75 call and you receive 4.5 points. And that's represented here by the red line. So you can see the S&P just trading away, rallies, makes a new low, comes up to around 27.50, and you decide to sell the 28.75 call. And by selling that, you collect for yourself 4.5 points. But at the same time, you place an order. At the same time, you also buy the 28.95 call, and you pay 2.25 for that. So the net result is you collect 2.25 points, or $112.50, because every point is $50, and of course you have to calculate your commissions as well. And that's on the EMini SP 500. Now here's selling a put spread. So let's look at that, and I think the graph will help us on that. So here you go. The S&P, the mini, is trading away, drops, recovers, corrects, and makes a new low, corrects again. And you might think to yourself, well, I don't think it's going to keep dropping a whole lot from here. So I'm going to sell a put spread. I'll sell the 26.15 put, represented by the red line. I will receive 3 points for doing that. And simultaneously, I will buy the 25.95 put, pay out $1. So I net 2 points on that, or $100. Every point's $50 minus your fees. And that is essentially selling a put spread. Now remember, these are not naked options. These are all covered. If anyone you know is trading naked options, or if you're thinking about it, don't do it. It might work for a long period of time until it doesn't. And when it doesn't work in a big way. So you want to always be hedged. You want your maximum risk capped. Covered option spreads. You don't want to be naked like this poor cat here. And here's an example. Here's the S&P around 2,800. And let's say you decide to sell a 25.85 put, represented by this red line here. And you collect the premium for selling this put. Maybe you collect, I don't know, 5 points. Doesn't really matter. But look what then happens. The market just drops and drops and drops like a rock. Drops down to 23.50. And let's assume you're still short that put. You'd be sitting on a loss of almost $12,000 if you were short that put and not covered and had done nothing to cover that trade. So remember here, you need that insurance. You want to sell only covered spreads. Naked options equals unlimited risk. And when you're doing these covered spreads, then I'm going to show you how we do them, but you don't have any risk of margin call. So that's a key point too. A lot of people doing these types of trades that are uncovered, they constantly have to add money to their margin call or make all sorts of moves that they'd rather not make. But when you're selling covered spreads, and the way we do it, you don't have to worry about these margin calls or these any accounts going upside down or anything like that. Now let's look at an iron condor strategy. This is a non-directional strategy. So what I mean by that is you don't have to be bullish or bearish. So what you do here, it's a simultaneous combination of what we just saw, the put spread and the call spread. And let's look at a graph, and that'll really explain it. We like to use the Iron Condor strategy on a stock market index like the S&P 500, and you're just hoping the index stays between the call spread that you sold and the put spread that you sold. And it's just that simple. You see a little bit of an upwards bias here, but for an Iron Condor, that wouldn't really be a problem in this particular example. And we'll show you also why that is the case. So here's a secret strategy, kind of a variation on the Iron Condor. And this is called a dragonfly. So this here is what the dragonfly looks like. It's a six-legged spread, not four-legged spread like the Condor. So this is just the same exact trading scenario using a dragonfly and not a Condor. So essentially, the red lines are the options you're selling, and you do it in multiples of 4. So you're selling 4 of the 2970 calls, and then you're buying 3 of the 3010 calls, and then buying 1 of the 2950 calls. And you notice the one that you're buying is closer to the money compared to the others that you are selling. So this long option here will actually gain in value quicker than these out of the money options here, these further out of the money options, and it won't lose time as much as quickly as the others as well. We're going to run through a demo on that. Now here's something we call, I bet you didn't know this. Let's look at the EMini SP 500 futures market real quick. Provide a little context, you'll understand what I'm getting at here in just a second. It says here, and here's a study they did here by the CME group. In every trading scenario, nearly every scenario, the ES futures contracts offer a more cost-efficient way to manage S&P 500 exposure compared to ETFs. Okay, you think that sounds all good and well? So what does that have to do with what we're talking about? Well, let me show you in just a second. It says ES futures offers significantly more daily liquidity, 8 times the value of all S&P 500 ETFs combined, including the SPY and the IVV and the VOO. Then it says here that traders are fleeing the individual stock options markets. We've seen customers pulling out of equity options, trying to trade other products. For example, customers shifting to futures contracts. The OCC data shows a 42% increase in futures volume in April. That's from a Wall Street Journal article. You can see the link right there. So very interesting. And it says here the bid-ask spread actually grew 30% in the last 5 years, having peaked in 2014. So that's not good if you're trading individual stock options. So if you're trading a lot of security options, well, you might want to think about doing something different, and that's what we're going to talk about. Now look at this. Meanwhile, the ES options have tight spreads. And ES, I mean the EMini SP 500. These are futures contracts, so the options on these particular futures contracts. There's a CME group study related cost comparison. Let's take a look. It says order execution quality with the ES options, that on average they offer superior execution relative to SPX options, and in dollar terms the ES options offer a cost savings of $4 to $15 per contract. So what that means is you have a tighter spread between the bid offer on each option that you're trading, so that reduces your transaction cost. Now here's something interesting too. It's kind of surfaced lately. We kind of looked at it briefly with a graph there on when they announced, was it Schwab announcing 0 commissions, and then TD Ameritrade and all the other stock brokerages, their shares sank like a rock. Well, let's take a look here at the hidden cost of securities trading. They talk about free stock trading now. Well, maybe nothing really is free, because the cost involved with every transaction now is very opaque. What I mean by that is there's something called payment for order flow when you're placing these orders and trading stock options, trading securities and stocks. So stock brokerages are paid by market making firms to route their orders to them for execution, and that makes the retail order ripe for exploitation. Now, it's not me just saying that. I'll show you here in just a second. So there are hidden costs in trading stocks, resulting in sometimes less favorable fill prices to the retail trader, and that can end up costing you more money. But the cost is buried in the transaction. So what do I mean by that? Well, here's an article called Robinhood Making Millions Selling Out Their Millennial Customers to High Frequency Traders. So here's a quote here, well on their way to making hundreds of millions of dollars in cash income by selling their customer orders to the high frequency trading meat grinder. These HFT traders are not charities, and the only reason these traders would pay Robinhood tens to hundreds of millions of dollars is that they can exploit the retail customers. So there's the link to that article from Sinking Alpha. So I thought that was interesting. Something to point out that really you don't know what the cost is. And when someone says it's free, you're paying for it one way or another. And I think we all kind of know that and sense that, but something to point out. So how about a variety of expirations and the ES futures options? There's weekly, Monday, Wednesday, monthly, quarterly, end of month. So there's at least 3 option expirations every week, sometimes 4. So there's a lot of opportunity for different trades, different expirations, different series. And also the advantages for these credit spreads on the ES, you have something we like to call a highly technical term, wiggle room. So as we know, the index is less volatile than an individual stock. So the market, that index might even move and pressure one side or the other of your spread position, but the actual value of the spread may not necessarily move against you. And we'll see why in just a minute. So that leads us to the Greeks. You've heard about the Greeks when it comes to options trading. Some guys go really, really granular and get heavily involved, and that's fine. But for our purposes, we're going to talk about 2 of them. We're going to make it super simple. First one, delta. What does it mean? It's just the percentage change in option value compared to the change in the underlying asset. So what on earth am I talking about? Here's an example. Here is the S&P at 2940. Here's a 2890 put at 15 points, the delta 0.25. So then let's say the S&P drops 10 points to 2930. So what happens to the value of this 2890 put? Well, it goes up 25% because of the 25 delta. So now it's worth 18 3/4 when before it was worth only 15. So just that simple. A couple key points. At the money options have a delta of 50, deep in the money 100, and deep out of the money 1 or 2%, very, very small. Now here's really a big, big part of delta. Some people are aware of this, some people aren't. So the word secret maybe applies, maybe it doesn't, but nonetheless, delta, this is important, equals the approximate probability of expiring in the money. So if it has a delta of 0.25, it means there's a 25% chance that it would expire in the money. But conversely, this is the real key, 75% chance that it would expire worthless. So delta is not static, it's always moving with prices and time as well. And it does not represent the probability of a winning trade. Now let's look at time real quickly, the sands of time. Isn't that from the days of our lives, I believe? Market might move against your credit spread, like I pointed out, but the value of the spread may not actually move against you, and that's because of time, something we call time decay, and that is theta when you're talking about options. Sensitivity to time, time decay, every option expires at some point and is a wasting asset, has a limited lifespan. So you refer to time as theta, expressed as a negative number equaling 1 day of time decay. So let's say an option's at 10 points, theta is negative 0.05. That means the next day, all things remaining equal, premium would be 9.95, then 9.90, then 9.85, and so forth. So no matter what, you're losing time with an option every single moment. So unless the underlying asset moves quickly enough and favorably enough in your direction, every out of the money option is 0 at expiration. So the theta decay is part of what gives these credit spreads the wiggle room we talked about, taking advantage of theta decay. Here's what it looks like on a graph. See, as you get closer to 0, in time, the value of the option just starts to really, really dramatically fall off and decay and deteriorate. So really, as a credit spread trader, you want to be in a boring market. You want to be the anti-life of the party. You want to watch the paint dry. Your whole goal is to sell out of the money spreads, collect the premium, then watch time pass. But of course, it's never that easy. Let's be honest, trading isn't that easy. So you need the proper tools, the proper approach strategy to be able to consistently manage the risk and reward of any trade that you have on board. You want to keep your emotions on the sidelines as best as you can. So how would you know that? How would you know how to do that? Options can be complicated. There's so many variables. There's so many choices. You know, how would you even know where to begin if you want to start to build a spread? Here's one expiration series. You can see the strike down the middle. You can just kind of run through real quickly. You can see the puts on the right, calls on the left. So nothing too complicated, but if you want to start building spreads, where would you begin? And then how would you even track them? And then how would you close them out? So just like Jackie Chan here, where would you start? What do you sell? Who do you sell to? Where do the premiums come from? How do you know what, when, how, why? All those questions. Manage the risk and rewards, leaving us a little bit perplexed, like Maxwell Smart. So here's the good news. We've done all this testing. We have all the experience. We figured out a fresh approach to trading complex option spreads. It's called Theta Trader. Drum roll, please, Theta Trader. And we're looking to collect premium by selling time, and we do that with pre-built credit spreads. That's the whole key. These are automatically created for us. And how does this happen? We use a proprietary algorithm that creates something called theta trades. That's what we call these spreads. These are the same spread strategies that sophisticated traders, professionals are using. And we've got an algorithm that generates these for us. And then here's the real kicker. Of course, any spread can be applied. You can build a spread for a bull, bear, or flat market, but we have automated risk and profit management, something called the RTI, the risk thermal indicator, and I'll show you that. So not only does the algorithm build the spread, it will automatically, manage that trade for us. So now that I've got your attention, we're almost ready for the demo. What do clients say about it? It's a superb trading platform. Anyone with minimal trading experience can enjoy the benefits of sophisticated trading. So if you like what you see, we're going to show you how to take action. So we are ready. It is time to go ahead, and I'm going to switch here and jump into the demo. All right, you are now looking at the dashboard for Theta Trader. So I think probably the best thing to do, not a whole lot to see down below the fold, as they say, but you'll see the different sections here, the Theta Trades, open sold, current quotes, account info. I think the best thing to do is just jump in and look at the Theta Trades. And you can see here that you can select any one of these tabs, and it populates bullish strategies or bearish strategies or neutral strategies. You can see the tabs here right now. This is the EMini SP 500, the NASDAQ 100, and Russell 2000. And you can see we talked about in our presentation here the dragonflies and the condors being the neutral strategies. So that's what we're going to look at. Let's look at a condor. And you can see here, these are the Theta trades. Anywhere from 17 to 75 days till expiration. So the algorithm has already built these trades for us. We don't have to do anything, but let's go ahead and drill down and take a deeper look into, I like to look at the trades that have the most time just because it just offers the most data to look at, that's all. No, just a demo account. There's really no rhyme or reason. So this is just to demonstrate how this all works. So let's click on that trade. And you can see here it pulls up all the details of this trade. Now the first thing I like to do is look at a chart. That gives me perspective on the actual trade in terms of where the market's been and where these strikes are. So you can see the S&P here trading away, chopping around, moving around, sitting here at this level. And this particular trade here is selling this call spread above the market and selling this put spread below the market as a condor. And that's what it looks like on the graph. That gives a lot of context. I like that a lot. So you can see here it has 75 days till expiration. The price on this spread is 2.6. You're looking to collect $130 net, and the risk, the maximum risk, is $1,000. And let me show you why. Basically, you have the 2570 put that you're selling, and you're buying the 2550 put as protection, and there's 20 points between those strikes, and 20 points on the mini S&P is $50. So that's where you get that $1,000 maximum risk. So now here's a question for you. Let's go ahead and let me show you something real quick here. Just a second here. You can see here that essentially your cash required is about $900, but your profit potential is a little over $100. So why would you risk 900 to make a little over 100? Remember we talked about delta. So let's look at the delta on the put that you're selling. The 2570 put has a delta of 9.55. So really what that means is there's over a 90% probability that that option is going to expire out of the money. Now look at the call you're selling, the 3180 call, 6.66 delta on that. So you're looking at around a 93% probability that this option is going to expire out of the money. So these are what we're looking at, what we call higher probability trades. Higher probability of essentially expiring out of the money, and therefore that is the whole key to this. Lots of base hits like we talked about in that baseball analogy. And here's something called the T-Rock, your targeted return on cash. And that kind of gives you a summary here of the parameters and the variables involved with this particular iron condor trade that's already built and generated. So you can see here it's set up to sell, pre-populated, because you're selling a condor. You want to collect the net premium when you sell it. And then the amount is 2.6 points. But of course, you could always adjust that if you want, or you can say, well, I'm willing to take a little bit less. So you could go, you could go down to, 2.5 or whatever. But you can also adjust these strikes, just so you know, if for some reason you wanted to modify them. But most people, quite honestly, just stick with what the algorithm does. That's the whole point of this, to make it easy. So let's go ahead and say we're doing a quantity of, let's just say 7 of these. And go ahead and place that trade. And there it is. It shows up as being filled. It's a demo order at 2.6. And it's just that simple. And let's take a look here. I want to point out something. Now this is really fun. We have a simulator. So I want to show you some trade simulations. We can look back in time and do some back testing. I've loaded some here. So here is an iron condor, June 2016 in a month. Pulls up a blank chart, and you would use these controls here to play or fast forward or go backwards in time. So let's go ahead and see what happens. And I'll explain what's happening here with these colors and all the different numbers flashing. So essentially here, 72 days till expiration when you place that trade. Then you can see day by day, the market's moving around, the S&P is moving, and this is all green, and that means good, do nothing. The algorithm says you don't need to do anything, just watch the trade ripen and leave it alone. So nothing to do. And you can see here it's a little bit negative, a little bit profitable, but nonetheless do absolutely nothing. So you keep going, and now it's turning more and more profitable with the green there. Keep playing. Interesting here, it actually turns blue, and blue means to take profits. So with 36 days remaining, this particular condor trade got ripe enough where Theta Trader said, get out and take profits. Now I want to point out something, that this can be automated, and I will show you how to do it. So if it turns blue, you can automatically instruct or have Theta Trader essentially automatically close out that trade for you at a profit, or if it turned a different color, I'll show you about that in a second, it can automatically exit and cover your risk. So that is cool stuff. And then of course you could just go back and replay it at any time or go all the way to the end or whatever you wanted to do. But let's take a look at another trade. Here's another Condor. Now this one's interesting here. I put it here for a reason. You'll see why. Okay, so it turned blue. So you could pull the trigger, get out and take profits and go on to the next trade when it turned blue, or you could have it automatically do that for you. And the reason I put this here, and I show this other trade as well, is because sometimes people will say, well, why would you get out of this trade early? Why not try to capture everything that you could have? You got out here when you captured about 70% of the maximum profit potential. Why not get 100%? Well, the answer is because you don't know at that time, where the market's going to go day by day. You don't know where it'll end up. So in this case here, let's assume someone saw this blue signal to get out and they decided, I'm going to stick with it because the market's just kind of moving sideways, just like I wanted. It's super quiet here and I'm comfortable that I'm going to just capture 100% of my potential target. Well, let's see what happens. It turns yellow. Yellow means caution. Theta Trader's warning you just to slow down and keep an eye on things. Goes green again, that's okay. Oh, then look at that. It turned red, and red means take your lump, take a loss on the trade and get out. The risk management within Theta Trader says to get out. So if you would have done nothing and avoided this signal to get out here and just stuck with the trade, you would have taken a winning trade and turned it into a losing trade. So that's one thing I wanted to point out, and that's what makes the automated risk and profit management so interesting. Let's look at a couple more. These are a lot of fun. I could do these, spend a lot of time on these. This one's kind of crazy, but I wanted to show you. When you're trading, anything can and will happen. So you place the trade here and almost immediately the market drops pretty hard, pretty heavy. Put some pressure on the short puts that you sold. Theta Trader turns red and says, get out and take your loss and move along. So the key here is that when trading, you need to expect anything and everything at any time, and you need to be prepared, and that's why we like to automate our exit strategies. Now let me show you here, before we get into the simulation on this one, I want to show you a dragonfly. So let's look at the dragonfly for just a minute. We're just going to go back to the dashboard. Here it is. And let's pick a dragonfly, just like we chose a condor earlier. And we'll look at the chart. And there's a good example of what the dragonfly looks like. Now we're doing these in multiples of 4, the ones that you're selling. So you're selling 4 of the 3180 calls, and then you're buying 3 of the 3220 calls, and then 1 of the 3160 calls. And then same thing down here, you're selling 4 of the 2570 puts, 3 of the 2530s, and then buying 1 of the 2580s. So it's basically for every short option, you have a long option, and that's what makes this a covered spread. And just to point out the reason, once again, why you do this is this 3160 call is closer to the money than the calls that you sold, and the 2590 put that you bought is closer to the money compared to the 2570 puts that you sold. So these cause the spread to act differently than a condor, and I'm going to show you why. Doesn't mean it's always necessarily good, better, or worse, just different, but there are some advantages to it. So let's assume, and there's another key thing too, because you're selling 4 options, essentially 4 spreads. The cash required on a condor is, we'd like to just round it up to about $5,000. So 45.26, so it's 5,000 minus the premium you collect, which is here. And of course, you add your commissions as well. So why would you risk $4,500 to make 473? Well, once again, look at the deltas: 9.55, 6.66 on the options that you're selling. So those are the high probability options. Those have over a 90% probability of expiring worthless or out of the money. So let's do a quantity of, let's just say we're doing one of these, and you're collecting 11.15 points. Remember, the Condor was maybe, 2.5 points. And of course, it depends on the environment that you're in as well. Sometimes those numbers can be higher, and the spreads can be a lot wider as well. So it just depends on the market environment. So let's go ahead and sell one of those dragonflies. And there it is. Shows up as being filled 11.15. And let's jump back to the simulator. I want to show you a dragonfly. So here is a dragonfly, April into month 2019. And here we go. We're playing. The market's moving sideways and doing the right thing here for this type of spread. And look, it turns blue with 34 days. So you're able to close this trade out here with 34 days remaining and take your money and move on. And that trade started on February 14 of this year at Valentine's Day. So let's look at the Condor from that same day, February 14. So this is the Theta Trade Condor from that same day, or that began that same day. So all is well, no trouble. Now remember here, you were able to get out of this one with 34, 33 days till expiration. Now on the Condor, we've already passed that time, and there was no signal to cover and get out and take your profits. So we have to stay in this trade longer when we're using the Condor in this case. There it goes. Now eventually, with 2 days left, it turns blue and it says take your profit and move along. But the key here is, in different situations and circumstances, a 6-leg dragonfly is going to allow the trade to ripen sooner than a Condor and allow you to take your money off the table and go somewhere else and put it to work elsewhere. So let's look at another one here. Here is a trade from June 29 of 2016, another Condor. All is well, turns yellow, turns orange, and orange is elevated risk. That is right next to becoming a red. So that means if you're following things day by day, you want to be ready to close that out and when it turns red. But if it's automated, of course, you don't need to do anything. So it's kind of wavering here because we're immediately getting closer to this upper boundary where we sold those calls. So it's vacillating between yellow and orange. Getting pretty close. I mean, it's really threading the needle right on the razor's edge. It's getting close. But I want to point out something. It's still green. The RTI is still green, even though we're trading at a level that's getting very close to that short call position. And that's because of theta decay. So the spread is actually still in an okay position, even though the market has moved a lot closer towards our upper boundary. That's because of time that's eroding. And there, finally it turns blue with 8 days left. Now let's see what happens if you would have had a dragonfly during that same trade. So it's still doing the same thing down here with the yellow and the orange, kind of making similar movements or similar signals here, kind of vacillating between yellow and orange, yellow and orange. Okay, let's see here, keep playing. And then it's going to yellow again, and then it turns blue. Turn blue with 22 days left till expiration. And you look at the Condor, and that turned blue with 8 days till expiration. So you had to sit in that Condor trade a longer period of time compared to the Dragonfly. So those are a couple elements I wanted to point out in terms of the Dragonfly versus the Condor. So it's something to keep in mind. It's kind of a very unique approach and strategy, and we've kind of created Theta Trader to take into account and make it so easy for you. And I'm going to show you something else here real quickly. So if you want to look at your open positions, you can drill down and see all of your open trades. You can also see them at a glance on the dashboard. But you can see here all the open trades. Here's your entry date and all the trades, your days till expiration down the middle column. You can see the P&L on all your open positions. Some are well into the green, some are a bit into the black. That's pretty typical. That's the whole point of selling this premium. It's just has to watch. You just want time to pass. And then you can scroll over and see the deltas on any of the options and any of the metrics here. And if you have questions on what all this means, I'll show you how to find that too. We have a great help file and videos. And then if you wanted to exit any particular trade, you just click the exit button and transmit your order, and that's how you would exit it. It's that simple. And if you want to look at, let's say, I don't know, let's say that we're looking at this one here with 11, the 11 Condor here. So you click on that trade, you scroll down, and there you go. There's all the details for it. You can see the history, what the market's done, see your short calls, your short puts, and you can see that settlement history. It's been green the whole time, no trouble there. And just makes it really, really simple. Then here are closed positions. This is kind of a good one to take a look at. So you can see all the closed positions in this demo account. And you also notice here there was a long, a B means buy. So we bought 3 Condors on the Russell. So Theta Trader can buy premium, they're just not high probability trades. So you can see all the closed positions going back in time. You can see the P&L on the positions, win or loss. And it shows you here a summary out of 18 trades, 16 were winners, 2 were losers. And of course, as a demo account, you can't really read anything into that as to what you might expect. Sold 17 positions, so we sold spreads 17 times out of 18, and we bought once. We bought one of those spreads. Now let's look at, we talked about the help file. Here's where you can find all the goodies here on the glossary of all the different trades. Here's your RTI. Here's all the different strategies outlined here. So everything you need in the help file. There's educational videos here if you need to brush up on some of the futures and options education. There's also tutorials, a whole video series on how to use Theta Trader right here. And then under settings, this is very important, and I'll show you this right here. This is where you would activate your risk manager. So you can automate the RTI, and this is where you activate the profit target directive. So the RTI can automatically close out your trade if you click both these boxes. So either way, you're going to be out before expiration, whether you hit a profit target or a risk management target. And it's just that simple right there under the settings. There's also something called Trade Scope. That's our proprietary research. You do it every day. Technical analysis. We're looking at primarily the S&P and giving some support resistance levels, looking at a few indicators. So you can see the graph there on the S&P, see kind of the outlook for the indicators, short, medium, long term. And then also here you can see key dates, market outlook, just a lot of great stuff within Theta Trader as well. And we also have something, let me close this here. We also have something called the Daily Trading Summary. It's more proprietary research here. It's more of a narrative format about what happened around the world, different countries and their markets, looking at the European markets, the Asian markets, and looking at any trades that were filled A lot of the quotes here, of course, your quote board. Then looking ahead onto the economic calendar, support resistance points. A lot of good stuff in there as well. So that is really a pretty good rundown. We can't cover every little detail in Theta Trader, but I think the key is we make it so easy. We automate the trade selection. We pre-build the trades for you with an algorithm. And then once you have the trade, you can easily monitor it here right on your dashboard. These are all your open spreads right here. All your positions are all made available. And if you try to track these in a regular brokerage statement, it's a nightmare. I'm going to show you that in just a second. So that's how easy it is to track these. You can just click on any one of them, drill down and get information. And then, one of the best features is you can automate. You can automate all the risk and the profit controls. So once again, we're just looking at drilling down to the open positions. There's one other thing here I'll point out, something called Trade Builder. So if you just want to start from scratch and build your own trade, you can. Just select the market, contract, strategy, whatever it is, and just follow the prompts. So most people use the Theta trades just the way they are out of the box, and that's good because that's the way we designed it, and you shouldn't have to spend time on this, and you've got other things to do. So now I'm going to jump out of this, and I'm going to show you probably what is the best feature of all. You will want to see this. All right. So hopefully you don't feel overwhelmed after that brief demo. There's a lot there, but actually it's very, very easy, very straightforward. Don't want to be like Lucy and Ethel there, getting overwhelmed with packaging up those chocolates. So here is the best feature, the best for last. It is the trade alerts. So we can do trading in just 1 minute. You don't even need to log into the Theta Trader platform sometimes, and I'll show you why. One-touch trading is what we call it. So these alerts come to your phone, your device, your tablet, whatever, and these are live and they're integrated with your account. So just to clarify and specify, a lot of times, and you're going to be signing up for some alert somewhere, you get something on your phone. Oh, that's interesting. I'll go look at that. You log into some other platform. You have to type in all the variables and parameters and so on, and hopefully you get it correct and look at it and then submit your order. You don't do that with us. These are already integrated with your account. You just touch accept and your order is placed with your AltaVest account. And then the RTI, of course, as you saw, can then automatically track and manage the position for you. So how cool is that? Let's look at a little video here. Here's a typical link. You would get a text message with a link. You touch that link, and here's what happens. Here's a description of the trade. There's a graph there of the trade. You can see the premium collected, how much cash required. Here's the quantity. These are already pre-sized for your account, and all you do is touch accept. And that's it. The order gets placed, so you can look at it again. I mean, how easy is that? And if for some reason you didn't want to place the trade, touch the red reject, and that's that. So great stuff. So what do clients say about trade alerts? For someone with a busy life who doesn't have time to sit in front of the computer, AltaVest is perfect. The best thing about AltaVest are the trade alerts. And it's true, we'll get calls and clients telling us, oh yeah, I was on the golf course when I got that alert, or I was flying my plane, or whatever. So definitely, you don't want to be a screen watcher. You've got your own stuff to do. Do not sit behind a screen. You'd rather be doing things with your family, on vacation, you name it. So with that said, hopefully I think you would agree that this was time well spent. You discovered something new and valuable. So here it is. Here's our special offer for Theta Trader. We have the Elite and the Pro membership. We talked about something worth over $18,000 available for free. Let's jump in. What am I talking about? The Elite membership. Here's what you get. You have access to Theta Trader, just like we saw. all the Theta trades. The proprietary algorithm pre-builds those trades for you. Simple and effective trade selection. Also, the trade tracking. Once you have a trade placed, how do you follow it? No more horribly messy brokerage statements. Here's a typical statement from any typical brokerage firm trading option spreads. I have no idea. I would have no idea where to begin to try to figure out what spread is doing what, where the spread was entered, what price it's at now, how much of an open loss or gain it's sitting on. You don't have to worry about any of that. You saw how easy it is with Theta Trader. Then, of course, the RTI. Automatically close out your trades when they hit a risk or profit threshold. It's what we call autopilot, non-emotional. You want to put things on autopilot as best as you can. Remember, the automated risk manager, it's all you do. Check that box there that's highlighted in yellow. Then the automated profit directive, check that yellow box there as well. And you can automate profits and risk. Clients say they've been doing iron condor trades for 6 years. Your indicator is the best tool for monitoring trades. How about the simulator? You could go spend, I don't know, weeks on that thing. It's great. You can back test. We have those animated charts, kind of make a game of it. Looking at past trades, back testing. Take a look, compare condors to dragonflies, call spreads, put spreads, whatever you need to do. You saw the trade builder. If you want to build a trade from scratch, you can do that too. So with Theta Trader, you have the Theta Trades, the RTI, the simulator, and the trade builder. Yearly value of $35.88. Software is expensive. People spend a lot of money on this stuff. I know, I've seen it. I see it all the time. Now remember, with the Elite membership, you not only have Theta Trader, but you have your private training with your own licensed trader. A one-on-one relationship with your own trader, someone who's experienced, who's done this, who knows what they're doing. And they have 1-hour sessions. Typically, people that are starting and they want these different training sessions, these are sort of kind of some similar themes. I'll look at the indexes, the Theta trade selection itself, comparing the Condor and the Dragonfly, using the trade simulator, diversification, setups, analysis, the trade alerts, and maybe even some other advanced strategies. So that's all part of the Elite package. You have that coaching, that mentor, that wingman, that co-pilot. How many other euphemisms can I come up with here? So you develop that relationship with a licensed trader, discuss your trade strategy, review your history, $7,500 value at least. And if you think, oh, it's not worth that much, well, let me show you this. Here's a trading education firm. They have 10 online option lessons in 3-hour sessions for $5,500. They have advanced options trading for $13,000. Then they give you lifetime access for $25,000, but you have to have 3 prerequisites. So there's nothing wrong with paying for great, valuable knowledge and information, but the point is, with your Elite membership, that's all part of it, and you have the Theta Trader platform. So you get that all wrapped into one. So how about those trade alerts we talked about? One-touch trading. One touch, just touch accept and you're done. And these trades are tailored for you and your account. They're integrated and live. And all you do is touch it, and then the RTI can manage it for you automatically. And those trade alerts are very valuable. People spend a fortune on trade alerts, whether it's on a monthly or quarterly or yearly basis, at least $4,464 value there. And once again, to get your trade alerts, you just go into the settings and you click here, get the trade alerts right there, and that's it. I love my trade alerts. They keep me informed when I'm traveling. Staff are always there to help when I need more information. So here's what you get with your Elite membership: the Theta Trader platform, worth $35.88. The private training, $7,500 or more. The trade alerts, $4,464 value, over $15,500 value with your Elite membership. So if this could do just the one thing that saved you all sorts of time and grief, money, aggravation, cancel other subscriptions, it would be worth it. I think you would agree it would be worth it. But of course, we talked about some other things that Theta Trader offers, such as the proprietary research, and that stuff could cost a fortune. We do that every day with TradeScope and the commentary, worth $29.52. And then we have the online videos, the tutorials. Those are all built in the Theta Trader. We throw those in there, of course. We want you to be comfortable with Theta Traders. No charge for that, of course. But yearly value, over $18,000 with a Theta Trader Elite membership. So it would be a great deal, even if it were half price, $92.52. But we'll do even better than that. As we like to say, we'll over deliver. Special webinars here. We like to do this, provide everything you need. You're going to love this. One time, $9.97. That's it. You see the link there, cf.altivest.com/TT Elite AV. Our phone number, 949-220-2720. That's a one-time payment. It's not monthly, it's not quarterly, it's not yearly. People always ask, well, is that, nope, just one time, and then you get everything. That's it. How about this? The Elite membership equals the helpful AltiVest advisor. The brilliant algo trading system never failed me, and neither did my helpful AltiVest advisor. So if that isn't good enough, how about a 30-day guarantee for that Elite membership? 29 days into it, if you decide it's not for you, that's fine. We'll refund that membership payment. No trouble. If you think it's not right, that's fine. But we do offer that membership, and I got to tell you, not a whole lot of people like to take us up on that. So I think that says a lot of good things about us. So the quantities actually are limited. It's a one-on-one boutique style of service, with all that mentorship, that coaching, that person alongside you. One-time payment, $9.97. Great deal. In fact, it's better than a great deal. And we talked about a free membership for the Elite members. $100,000 account or more, we'll go ahead and refund that membership fee, so you can talk to us about those details. Now, what about this? What about the Theta Trader Pro we talked about? So how is that different than Theta Trader Elite? Well, this is set up for people who might think, I love everything about it, but I really don't need someone over my shoulder. Well, that's fine too. You can get started, a one-time payment of only $4.97. You see the link there. And actually, with Theta Trader Pro, we can do better than that. How about free? That's always a good price. So if you want to just roll with this on your own and dig in, and you don't need that one-on-one close attention and mentor coaching, that's okay. That works. And there's the link, cf.altivest.com/ProTT. So there's the Elite versus the Pro. You see the difference essentially is the private training and that coaching. That's the big difference, of course, or really the only difference between the Elite and the Pro. Now, what about what types of accounts? People always ask, and we'll get into more of this in the FAQs about IRA accounts. Yes, you can have an IRA account, or individual, joint, corporate, LLC, trust, all that good stuff. And speaking of accounts and IRAs, what about tax efficiency? Yes, if you didn't know it, trading futures options is tax efficient, much more so compared to trading in the security space if you're holding things for more than a year. So that's because everything we do here is taxed at 60% long-term cap gains versus, and then 40% short-term. So the 60-40 applies to our trading no matter how long you're holding these positions. So here's an example, probably better just to show you the math. Someone trading stock options, $100,000 account, they get a 20% return. They would have a $7,400 tax liability and a rate of return of 12.6%. If you're trading futures options, then you'd have a $5,360 tax liability, rate of return of 14.64%, or a tax savings of over $2,000 just because you're trading futures options and not stock options in this example. Also, keep in mind losses can be used to write off other gains. They can be rolled backwards. You want to consult your tax advisor. Then there's no more itemizing when you're trading futures options. None of that messy wash sales and all that baloney. So it makes it real easy. You get one figure, what's your gain or loss for the year, and you plug that into your taxes. What do clients say about Theta Trader? We like to call them our sticky clients. I've had an AltInvest account for 10 years. Let's see here. They have incorporated a broad spectrum of market analysis and trade alerts, included suggestions on a wider variety of types and combinations of trades. The staff has been invaluable in continuing my education in trading index options. Been with AltInvest for 13 years. They have been a professional team. I've been with a client for over 15 years. So act now, you get all this value. Or if you take no action, what does that get you? Well, that's 100% risk and reward free, and it really doesn't get you anywhere or advance the ball any. So the membership, either way you go, equals tremendous value. Here's a client says, AltInvest has exceeded my expectations with their pre-selected Theta trades. Responding to an alert takes about a minute or two. A chart and the parameters are provided. I do not need to spend time at my computer trying to define my next trade. Boy, I think that says it all. That's the whole point of Theta Trader and the alerts. Thought this was interesting too. Jeremy Grantham, he was one of the few who actually capitalized on the 2008 crisis and actually predicted that would happen. But he says in the next 20 years or so, stock market real returns could be 2 or 3%. So if you're looking at the macro view, I know we talked about some of the pundits and gurus earlier and how they don't really offer a lot of help. And that's true day by day. I don't think it's too helpful to look at the punditry class and the media and the talking heads. Here's someone looking out 20 years, looking at the broader picture. So don't know if he's going to be right or wrong, but something to keep in mind. So you might want to consider having some exposure to something that is alternative in nature, something that has more of an absolute return characteristic, such as what we just talked about here with Theta Trader and collecting premium and selling these spreads. So summary, Theta Trader platform, you get the Theta trades and the RTI. You have the private training with the one-on-one access with the elite membership. The trade alerts offer that one-touch trading. You have the trade scope research, all the guidance you need. Education, videos, we talked about that. And the tax advantages, tax efficiency. Now, FAQs. People always ask, even after this presentation, can I trade stock options with Theta Trader? And no, we specialize in options on the EMini stock index futures space, and we saw a lot about that and some of the reasons why. You know, large growth, volume, liquidity in this space, and then the benefit, of course, would be the tighter spreads. You only have to track one or two markets, not thousands, and you have a clear cost structure. It's not opaque. There's no monkey business going on with payment for order flow or anything like that. So can I use Theta Trader and the alerts with my current brokerage? Well, we are a brokerage firm and Theta Trader is our proprietary integrated service. And speaking of performance, people will ask, what is your performance? And as a brokerage firm, just keep in mind that every client makes their own trading decision. So there are no performance metrics to report. Now, as a reminder, all of the calculations in Theta Trader, and I didn't point this out earlier, but they are net of all trading cost. So all the percentages you see within Theta Trader are net of trading cost. So that begs the question, what are your trading costs? So our commission rates are very competitive. Our EMini rate is 5.25 round turn all in. So even if you see other published rates for futures options, it's always going to be per side. So these big brokerage firms always post things as per side, and then they add more fees on top of that, making the total higher. So be sure to read the footnotes and the asterisks, and you'll notice that once you add it all up, a lot of times it's even more. Of course, there's always going to be someone who's less. We're not in a race to the bottom, but you know, keep in mind too, we're in a different space than securities. We're not trading securities options. These are futures options. So that race to the no commission or commission free thing doesn't really apply to us. It's not part of our space or industry. So how much money should I start trading with? Well, we talked about how much is needed for one ES Condor. It's about $1,000. So, and 5,000 for a Dragonfly. So if you want to simultaneously have, you know, 10 or more separate spread trades, all diversified among different strikes and expirations and markets, we suggest at least 25,000. So with that said, if you liked what you saw, take action. Theta Trader Elite, if you want that that training, that mentorship, and that coaching. And then Theta Trader Pro is available as well for people who want to kind of just run and do it on their own, so to speak. So we talked about those hurdles, crossing those hurdles. I think we've been able to cross those hurdles, right? One of them was all the noise. Well, Theta Trader really cancels out the noise, does a great job of that. Chasing performance. We're not chasing the performance of any benchmark or anything else. Theta Trader just works sort of as a independent absolute return vehicle. And by that I mean it doesn't really rely on the market moving one way or the other or having to pick the correct direction up or down. And then the emotions, you saw how you can automate your risk and profit management with the automated RTI. So with that said, we'll leave you with this here. You get your lifetime membership, Theta Trader Elite. You get that one-time payment, $9.97, or Theta Trader Pro. Either way, whatever's comfortable for you, it's comfortable for us. You can give us a call if you have any comments or questions. It's been great presenting to you, and if you need to chat with any one of us, give us a ring, or if you know what you want to do, visit those links and you can go ahead and get yourself signed up, and we will be in touch on how to get started. So I appreciate your time, and we will be in touch. Have a great one. Bye-bye.